welcome to another edition of The Expert Says, where this month James Clemster and Glyn Owens of Momentum Global Investment Management discuss May's sharp setback in the financial markets and the historic lows suffered by safe haven government bond deals. We hope you have a great month.
Glyn, May was clearly a difficult month for investors. What key points would you use to summarise them all?
Yes, it was a very tough month for investors. In our call a month ago, we alluded to the likelihood of a risk-off period in markets. So markets would set back after having a good start to the year. We could certainly see some dangers ahead. They were more than justified. In the event, the MSCI World Index, the developed markets fell by 8.6% in the month, and is now off by about 12% from its peak levels earlier this year. And within that, there were some pretty sharp falls amongst individual markets. So it was a very tough month for equity investors in particular, and they felt the sort of brunt of the selling across most of the asset classes. Although I've got to say that commodity markets were also very weak, and I think it's worth reflecting on that, just how far the oil price in particular has come down in recent weeks, now down by about 20% from the peak. So a tough month for risk assets, definitely.
You mentioned pockets of the equity markets struggling more than others. What areas were particularly poor?
Well, intriguingly, if you look in local currency terms, the weakest major market was Japan. Fell by just over 10% in yen terms in the month. There were individual markets in Europe which fell more sharply, and no surprises which they were. Greece fell by 25%, Spain was down by about 15%, Italy down by over 10%. So peripheral Europe very weak, but in aggregate, the US, UK and continental Europe all fell by about 6 or 7%. And again, intriguingly, Asian markets, excluding Japan, had a really very sharp fall, down by almost 12% in dollar terms in the month. So there was a mixed pattern, and some surprises to the extent to which individual markets reacted to this sort of risk-off period.
Okay, and the quintessential beneficiary of risk-off periods is the government bond market. That again was the case in May.
Yes.
In terms of headroom, though, we must be running out of space for that.
Well, it was an extraordinary month in government bond markets. The safe haven markets, by which I mean the US, UK and Germany. You could include Japan in that, but Japan has had these very low government bond yields now for decades. But those three big markets, US, UK and Germany, all saw yields fall to new historic low levels. In the case of Germany, the 10-year yield went close to 1% during the course of the month. In the case of the US and UK, down at about 1.5%. Numbers, quite frankly, that if somebody 4 or 5 years ago had said we would be trading at in 2012, I don't think many people would have believed them. So it was a real reflection of the concern in markets about the risks in markets, and indeed about the slowdown that we have seen in economic activity again. So in many ways, I think the moves in government bond markets were more instructive and more dramatic than those in the equity markets. And of course, outside the safe haven markets, the weak peripheral European bond markets saw quite sharp rises in yields.
In terms of then the backdrop, if you like, to these events, what are the main causes of this recent bout of anxiety?
I think there are three critical factors now impacting on markets. One is what is happening in the US. There has been some evidence of a bit of a slowdown in US economic activity in recent weeks. The purchasing managers' indices have been somewhat weaker. The employment numbers, whilst not bad, have not been as good as people anticipated. So people are worrying that the US won't be able to sustain its growth as we go through the course of this year. And of course there is the worry later on in the year, post the election, that we're going to get some fiscal austerity tightening policy coming in. So that's certainly a worry. The second is very clear evidence that there is a slowdown going on in China, and clear concerns that slowdown will turn into a hard landing. And growth levels that we've become accustomed to in China of 10-12% over the last decade now looking more like 7 to 8%. So that's quite a serious worry, and I think a factor incidentally why Asian markets were so weak in the month. But the third thing, and without question, the biggest worry for investors and markets has been the events in Europe yet again, which have come back to be a real worry for markets. We had the Greek elections on May the 6th, right at the beginning of the month. It effectively produced no government at all. There was no party that could form a majority. A clear swing away from the parties that had been in favour of the current bailout terms and the austerity package towards parties that were actually prepared to renegotiate those terms and raising the spectre of the Greeks actually disorderly defaulting and coming out of the euro. And we now face, incidentally, we've now got a caretaker government in Greece because a government couldn't be formed post the election, and there's a second election on June the 17th, which will be a critical test, of course, for whether Greece stays in the euro or out. So that was a really major factor. But during the course of the month as well, the problems in the Spanish banking system, which have been bubbling away, I think clear to all, there's been a big problem there, really came to the fore when the government effectively had to bail out and pretty much nationalise Bankia, the fourth largest bank in Spain. And we know the problems, of course, massive property loans that were made in the boom, and many of those have gone bad. So Bankia is now 45% owned by the Spanish government and requires, wait for it, a 19 billion euro bailout. And it is yet to be determined how that's going to be funded. That, again, is a major concern. So I think these are the really big factors that cause this setback in markets and keeps markets very nervous, incidentally.
Of all three of the three main causes that you suggest, they are surely an opportunity for the official sector, governments and central banks and the like to get involved again. Do you think that's likely?
Yeah, I think we're seeing a pattern in markets that has now been going on for the best part of 2 years, where you get these periods of intense stress, not just in Europe, but of course primarily in Europe, where the markets take the politicians almost to the brink and force the hands of the politicians. And there's no doubt the politicians in Europe have been very slow to react to the scale of the problem in Europe. So we have these periods of stress followed by periods of intervention. It's fair to say that the intervention that's taken place to date has generally been too little too late, but whenever it comes along, there's a huge relief rally in markets, and we're probably not very far away from that. I don't think there's much doubt that we are now in the sort of intervention stage where the European authorities will make moves to assist Spain in effectively recapitalising its banking sector, and there's talk of between 40 and 80 billion euros being required, and helping with that recapitalisation without imposing upon Spain the conditionality, the sort of fiscal austerity that was imposed upon Ireland, Portugal and Greece when they had their bailout. So we're getting close to that situation, but we're not there yet. In the meantime, the central banks around the world are effectively keeping their powder dry, what powder they've got. The ECB, the European Central Bank in particular, when it met during the course of this week, did not make any further moves on monetary easing. I think there's a very, very strong chance that in July they will actually cut interest rates, providing the European politicians have made their moves to assist the Spanish banking system. So there will be more monetary easing, and there's no doubt that the Bank of England and the Fed in the US are ready and waiting with further rounds of quantitative easing if required, given this slowdown we're seeing in economic activity and the general cautiousness amongst investors, both corporate and individual, around the world.
Clearly then, risks remain, but looking on a more longer term basis, what opportunities are out there and how should investors position themselves for that?
Well, it's easy to get carried away by the negatives, and there are plenty of negatives as we've discussed. I think it's clear to see how some of those are going to pan out. The European question is much more difficult, and so I think we will have periods of sort of risk on, risk off, stress intervention over quite a long period of time to come. But I think those periods of stress when markets fall as much as they have, and remember, individual markets now are down by 20%. Japan is one, Europe is another in the past couple of months or so. they certainly are giving rise to pretty extraordinary valuation opportunities. So within equity markets, there are now some pockets of really very good value, the sort of valuations that we haven't seen for a long period of time. And remember, equity markets have gone nowhere for more than a decade now. So we're focusing very much on that, and having lightened off our equity positions early in April, we're now looking to add to positions in this period of weakness, really on a valuation basis. We're not saying that there's now complete clarity about the way the European crisis is going to pan out, but it will ultimately be resolved, of course. We certainly concerned to make sure that we participate in any rallies that take place. And I think we could well be facing a rally over the course of the next few months once the Europeans make their moves to help the Spanish banking system in particular, and assuming that the Greek situation doesn't result in a disorderly default, which I think is probably the least likely outcome. But of course you can't predict this with any confidence because it's all politics.
Okay, thanks, Glyn. So generally speaking, remaining neutral to potentially overweight equity as we move forward through the year?
Yes, we're looking to maintain our positions at around neutral weightings versus benchmark. If we see further big setbacks in the course of this year, we'd certainly use that as an opportunity to add to positions. I think a couple of other positive factors worth bearing in mind: the oil price, which has been quite a drag in terms of consumer spending, having been so strong, it's fallen now by 20% pretty quickly, and that is going to be reflected obviously in pump prices. It's going to be equivalent to a tax cut to the beleaguered consumer. So that's worth bearing in mind, and I wouldn't be at all surprised if the oil price came down a bit further in this environment of weak growth. The Saudis pumping at pretty much record levels, there's plenty of supply, so I think we could well see the oil price coming down further. That ultimately is a big positive for economic activity. So there are pockets there that I think it's easy to ignore those at the moment given the uncertainties. So we would certainly be looking for opportunities to add to positions. We certainly don't see any value in conventional safe haven government bond yields of around 1 to 1.5%. There's little money to be made out of those. We retain our positions in credit and high yield, which have actually held up well in this shakeout. High yield was only down just over 1% in the course of May against a fall in equity markets of 9%. So we were pleased to see that performance, and it still looks good value. So we maintain positions in that sector as well as credit.
Thanks, Glyn.